inflation debate continues to rage. Most policymakers say prices are rising at a modest pace and certainly not fast enough to warrant a rate hike. On the other side, critics say the Fed is ignoring obvious signs that inflation is a real threat. One such critic is Keith McCullough, CEO of Hedgeye Risk Management and a Bloomberg Television contributing editor. Keith is with us by phone this morning. But Keith, I do want to, before we get into this conversation about inflation, I want to talk to you about Tim Geithner's decision to delay the currency report that could have labeled China a manipulator of the yuan. You have been very vocal on the subject of China. Do you think Geithner's ploy will work?
Yeah, Eric, I do think that, and this is probably the first time I'll say this, but I do think that Geithner's making the right call on this, and I do think that this is the right thing to do within the context of the calendar. So you have three things. You have Geithner making a call this morning. You have President Hu Jintao is basically going to come to Washington on Monday, next Monday, and in between that, you have this Friday trade balance report in China, where China is most likely going to report their first trade deficit, Eric, in the last 6 years, and it's a monthly report. So there is a political point here that Geithner's trying to get ahead of, which the Chinese are going to tell us, which is inflation is effectively creating a trade deficit on a short-term basis in China.
So we can actually frame Geithner's decision in terms of inflation.
Absolutely, and I think that that's why I have to commend Mr. Geithner for his decision. He's getting ahead proactively of what the Chinese are going to be, really politicking with, which is saying, hey, look, inflation matters. We're running a trade deficit. There's no reason why you should be calling us a currency manipulator.
Now, Keith, Tim Geithner may be getting out ahead of it, but as you have said many times, few other people are. Let's talk about some of the other inflationary pressures that you see out there. One of the things that you and I were emailing back and forth about last week are these new iron ore supply contracts and the likelihood that they will lead us to higher steel prices.
Right. You have a massive catalyst there with the 90% price increase from Vale. But at the end of the day, after we saw that, Eric, we saw a massive melt-up last week in a couple of the main commodity components that are leading, not lagging indicators. Dr. Copper, of course, is number one, and you're not seeing any weakness there this morning either. You see copper was up 5.9% week over week. The price of oil was up 8% week over week. And it's not like, we're coming off low levels. For the price of oil, we're at 17-month highs, 20-month highs for the price of copper. So just within the commodity complex alone, I think that just very simple math can get you there.
Well, the math may be simple, Keith, but there are a whole host of people out there who say it's different this time. And if it weren't different, we'd see Treasury yields at much higher levels than 3.95 as they are this morning. What do you have to say to those folks?
Yeah, maybe they should read the book. Actually, this time is different from Reinhardt and Rogoff, because a lot of people, seem to be pretty well versed right now, Eric, in sovereign debt, but they failed to read the chapter, chapter 12, as a matter of fact, on what is born out of all this, which is inflation. And whether it's Mexico in 94, Asia 97, Russia 98, or Brazil, for that matter, 99, it always ends in inflation. It's just a government exercise to figure out whether or not they can convince you that the reports are or are not inflationary. Now, next week, we're going to get accelerating CPI and PPI in this country alone. So we're going to, everybody who's saying that there is no inflation is going to see a sequentially accelerating inflation report, and we're going to have to go from there.
All right, Keith, thank you very much. That is Keith McCullough of Hedgeye Risk Management, always outspoken, and this time with a little recommended reading.